My name is Joel Weber. I'm the editor of Bloomberg Markets Magazine. Just want to say thank you for being here. Thanks to our sponsor. I hope that you leave here with your mind blown a little bit, and then you'll go and have it blown at one of the other programs that are happening today. The unique thing about this format is that I'm going to ask Jeffrey some questions, and then after about 20 minutes, we're going to open up to the room. So as we're talking, I want you guys to start thinking of questions because you're only going to have about 10 minutes to ask them. So start getting them to the top of your brain so that we can end with some great questions. So we're here not just listen to me talk, but we're here probably to listen to you talk. You're Jeffrey Tarrant. You've been in investment management for a long time. First and foremost with something called Protégé Partners, which is sort of a fund-to-fund manager of managers. But now you have something new called Move 37. It's on your hat. What is Move 37, and why is it called Move 37?
Yeah, okay. Thanks for inviting me. Move 37, it's on my hat. I didn't mean to wear this as a commercial. I went through some treatments this summer and lost some of my hair, so it's a dual function here to cover my bald head and also to tell you a little bit more about Move 37. So what is Move 37? About 3.5 years ago, we started at our firm to look at how does what we were just all talking about, artificial intelligence and everything, affect the investment management process from kind of a 30,000-foot view. And how Amazon, how he was talking about Tesla, how they've changed their industries. And so what had happened was about halfway through our research, something happened where AlphaGo, which was created by a company called DeepMind out of University College of London, beat the Go champion. And a lot of people know about that. His name is Lee Sedol. But what's not known too much is how it happened. And what happened was, and by the way, there are more people that watch that game than watch our Super Bowl, right? The Go game is very big in Asia. That's the first thing. Second thing, like our Super Bowl, there are a lot of experts sitting on the internet and streaming and looking at the different moves and making comments about the moves. And when the 37th move was made, the commentators would say, "Oh my God, something happened. The machine was unplugged, whatever." Lee Sedol, who was the champion, walked out of the room for 10 minutes or so, came back, kind of knew the game was over. But this is the first time that a computer, an artificially intelligent computer, actually thought outside the box, came out with a move that has never been seen before. They called that kind of a human characteristic. And so that was the...
Because it was actually learning as it went, right? And then it saw something that no one else had ever really seen in the history of this game.
Yeah, and learning is the key. And you know, we're in this area right now, and we think we're in the next generation of money management, which is we call autonomous learning investment strategies, right? Computers teach themselves, and by the way, you teach yourself. That's what I've been doing for the last 3 years. I don't have a master's in science or whatever, but I feel like I have a master's now because I spent the last 3 years. And your kids and you educate yourself differently than you did before. You know, you don't have to go to college anymore. You can go and watch. You can watch machine learning professors from MIT go walk through the whole course. You can teach yourself by watching. And so learning has changed, and that's the operative word, learning.
Right. And actually, if we frame this even in a more meta way, I know from talking to you a little bit before, this is a before internet world and an after internet world, which happens to be AI, right? So talk to me about that framework.
Okay. You're right. That's interesting. The AI meant after internet, but you're saying it's also artificial intelligence. Okay, I got it. So there's two interpretations. But that came from a guy by the name of Joy Ito, who I know very well, and he runs MIT Media Lab. By the way, he's the first guy that ran the MIT Media Lab that, one, doesn't have a PhD, doesn't have a master's, doesn't even have an undergrad degree, right? And you should pay attention to what they're doing in some of these areas, right? But anyway, so his book that just came out about 8 months ago talks about BI and AI, and that the whole world has changed. After internet, everything has changed, and you have to live your life within the context of that. Oh, by the way, his last chapter in the book is all about the 37th move, and it was actually funny because I went to his book signing, and next day I had breakfast with him, and I said, "Gee, your last chapter is all about the 37th move." I named my company Move 37 last summer, so it was a coincidence, but it's a very significant event. But living life after the internet and with artificial intelligence, I think what is happening in my industry, and I needed to be reflective on this, and is that so many industries have been affected, right? And so how is it affecting our industry? And I think if you take it to the kind of meta level, as you express, the meta level is, what is the investment management process? And what have these guys, I call it the West Coast guys, who just run down the West Coast, Google, Tesla, Amazon, there are some East Coast firms that have done this. But what have they done? They've been run by engineers or scientists or mathematicians or whatever who've examined the process of whatever it was, whether it was selling retail, whether it was logistics, whether it was Google inventing AdWords, which basically kind of wiped out a lot of the things on Madison Avenue. And everything is being reinvented by examining the process. So let's examine the process of money management. And I'm just going to kind of quote a very significant figure in the industry. He came out with a book. David Swenson at Yale is considered to be one of the best investors, and he talks about the repeatable process that you look for in money managers. And I look at it as kind of the Darwinian evolution of that repeatable process. First of all, repeatable process is kind of, it feels really weird to me to talk about that. All your consultants that run pension plans, all your asset allocators talk about the repeatable process, but what that connotes to me is like wash, rinse, and repeat, and you do the same thing over and over, and you get attractive rates of return. Now, I believe that in very highly specialized, very complex, very legal or whatever processes, like in the hedge fund business or long only or active management, I totally believe in that. But when it comes to large cap stocks, and there's been something that has happened where it's now being enforced, and if you've ever read the book Black Edge, is that the first part of the process, for the three-step process of creating value as an investment manager, is your information edge, right? And I've been in the hedge fund business for a long time, and I used to invest with managers who would kind of look at me, wink, wink, nod, nod, and said, I know a lot about technology, or I know a lot about this. And by the way, these guys are my investors, and wink, wink, nod, nod. I get a lot of really good information. I go golfing with Tommy Hilfiger, or I had dinner with this and that. And so, that was made illegal in the year 2000, Reg FD, right? But, to be brutally honest, it wasn't really enforced that well. And then things started happening where they created expert networks, and then it wasn't until 2013, and this is a recent event, that a very famous investor paid a $1.8 billion fine, and his employee went to jail. So now you're an active manager, right? And you look at that, and maybe you're a hedge fund manager, and you're worth $200 million or something like that, and you look at your decision tree as a business person, right? And the decision tree is back off my edge, pay a fine, or go to jail. So what you're finding now is people are backing off their edge. And it's pretty well evident in the hedge fund performance world, right? The average hedge fund that is long-short equity over the last 5 years for institutions has achieved about a 5% rate of return. Paltry relative to what the indices have done, what QQQ has done. And so what changed? And I think what changed is since they back off their edge, where do they end up at? They end up in what I call four-quadrant data land. We won't get into that in detail, but basically there's traditional data, structured data, and unstructured data, alternative data sources. And so what's happening is data is growing at the rate of Moore's law, or maybe even faster. It's doubling every 18 months or so. And so,
which is one of many factors that are kind of bring us to now, right? Because we're at this moment where there's a confluence of big data, cheaper computing power.
Yeah.
What does Move 37 do to take advantage of that moment?
Well, first, the Move 37 types of managers are usually managers that have skills that it's a next generation of managers that have separate skills than what the previous hedge fund managers did. And I don't want to denigrate, where I went to school. I got out of Harvard Business School, and I went straight into the hedge fund business. So that was, 1986 or so. And we were investing with all these kind of young upstart guys like Paul Tudor Jones, Louis Bacon, who were in their late 20s and early 30s, and Jamie Dimon of York Capital. So what I'm saying is that there are all these people between age 25 and 35 that usually come from outside an industry and reinvent an industry. And when I got out and I was telling my Harvard classmates, basically only 4 of us went into asset management. Everyone went into McKinsey, real estate, all that sort of stuff. But what I'm saying is that this investment business was reinvented by all these guys that came outside of Fidelity, outside of the traditional asset managers. And they came from prop desks, they came from risk arb groups, they came from trading options and futures. They invented the business, right? And so what's different between that generation, the current generation that we have today? And we basically call this current generation the third wave, right? The first wave was discretionary asset management, people like this that used their gut or whatever it was to build profits. The second generation was invented by quant, James Simons, Renaissance
Technologies, yeah.
So, and the coincidence is that when in my background, I worked in the hedge fund business, and then I went off to Germany. My partner in the hedge fund business in California, in Berkeley, a year later, after I was working for this billionaire family in Europe, and by the way, back then they were the primary source for all hedge fund investing. Endowments and foundations weren't even there yet, right? And so I'm in the middle of this whole group over there, but what happened was my partner went to work. He was a PhD in math and computer science. He went to work for Jim Simons. So Jim Simons was the next wave. And what he says, I'll never hire anyone from finance. Unless they're going to market for me.
You got to have a PhD after your name.
You got a PhD. It's got to be deep science. You're only going to use science to give predictive sort of, where you're going to go in the future. So this third wave that's coming out is kids that are coming out with the ability, and by the way, some of them have a title that we've never heard of before. So you're talking about a confluence of all these new things that are happening. First of all, data growth is growing at the rate that's never been seen before in the history of the world. That's the first thing. Second thing, it's coming in different shapes and sizes. And now that it's coming in different shapes and sizes, who knows how to structure that unstructured data? There's these so-called new people out there called data scientists, right? That career didn't even exist. My kids go to Brown University. One just graduated. They've just instituted at Brown a degree in data science, right? And so these data scientists know how to structure unstructured data. Right. And so they're not typically coming out of the hedge fund world. They're coming out of Google, Facebook, Palantir, and those types of organizations, right? And then they're applying their skills in this area.
So one of the things with Move 37, though, we're taking data scientists, pairing them with unstructured data, right, and turning them loose. We're not talking about large teams of people doing this, right? We're ultimately talking, you can do this with a handful of...
Okay, so when I started Protege Partners, which is my firm that now we're evolving to Move 37, is that we decided not to invest in quantitative managers because although I was an early investor in the Renaissance Medallion Fund way back then, the argument back then was, hey, you need to have 100 PhDs or something like that, 50 to 100 PhDs, and small teams cannot do this, right? And I believe that, and I believe it for a primary reason was back then it was hypothesis-driven. Your costs were very high with computational power. I even remember the costs that were set up back then, and the reason why Jim Simons told me that their high fee structure was we have to have a T1 line between the East Coast and West Coast. That costs zero now. It's called the Internet. And so cost structure has collapsed down. And what I'm saying is that you don't now need to have 100 PhDs because the way computers work today, they're not hypothesis-driven by hypothesis testing and all this sort of stuff. They just need data, and they will come out with the model. And so what you need is a few PhDs, a few people guiding the machine to say, oh, well, that model that you just came up with is super silly. I mean, it could say that the number of windows and all this building here are correlated to the Russell 2000 on a Tuesday afternoon. You have to kind of kick out the bad models, right? And there's so many more models that come out of a machine learning environment than the old hypothesis-driven. And so it's just a different business. And part of that is because a lot of the techniques that are used, machine learning, unsupervised, supervised learning, all that sort of stuff, these are methodologies that have been around for decades in white papers, but they hadn't been exploitable because you didn't have the computational power, one, or it was just too expensive. And computational power has basically, what cost $1 million to compute when I first got into the business, cost less than 4 cents. But it's not the cost. It's the availability. And it's the AWSs of the world, the Googles of the world that allow you to have computational power. So here's the misunderstanding that people have about us now. We're not a machine learning fund. That has nothing to do. It has a component in what we do. We're finding managers that utilize these skills, but it's data science, it's machine learning, it's a new regulatory environment, and those that are also willing, since the cost structure has collapsed, to pass that through and lower fees. And the primary complaint, and we're famous at Protégé for having this bet against Warren Buffett, of he thought that an index like QQQ, except he picked the S&P 500, would outperform a series of hedge funds, and his primary argument was it's the fee structure, and we agree. And so we kind of wrote a piece in an article in P&I magazine talking about how fees should be structured in the hedge fund community. But what I'm talking about here is much bigger than the hedge fund community. It applies to all public markets investment management.
So, talked about many things there, but one that I want to kind of go back to just to keep the eye on Move 37 is how are you figuring out who to invest in, and what do you see in that group of people that you've never seen before? What excites you about them?
Yeah, well, first of all, we have brought in some other teams to augment our skill set. And tomorrow, actually, my chief science officer, who's an MIT guy,
we'll also be talking with her.
He'll get into the weeds, right? But again, at the 30,000-foot level, you have to change your process of how you select a money manager. And a lot of that is geared towards what sort of methodologies they use and how do they stick to it, how much human intervention is in those methodologies. And here's what we did. I built a database in my background while I was running all these other assets. And that database is called AltVest, and it's now a division of Morningstar. And so it was the first hedge fund database on the internet, and it was the largest when we merged it in with Morningstar. And so what we did in this exercise is try to find out, and we went to the universe and said, who is actually doing this? And we found 200 managers that we interviewed. And my view is 170 of them it's just hype. It's like, we're the new guys, and we're going to use machine learning, and it's total hype. So beware. You need someone to help separate the wheat from the chaff. But of the 30, what are we looking for? We're looking for those that are using certain types of methodologies, diverse methodologies, and also different data sets, right? And so that's the way we get our diversification. It's not your classic way of asset allocation of saying, oh, gee, I'm going to have a European manager, I'm going to have a U.S. manager. No, it's public markets, and it's looking at different types of methodologies and the data sources they use. And the important thing is, the data, as I say, and this is a data company here, Bloomberg, this is growing at the rate of Moore's Law, and you're seeing new data sources coming out on literally a daily basis.
And what's interesting about that is that that's where you find the potential alpha, right? It's just it's looking at all this new unstructured data that no one's ever looked at before, and shaking it loose to see where you can maybe generate some alpha, right?
Yeah.
So I know that someone will ask this. So, and reminder to ask questions here briefly. How much real return is there in this stuff?
Well, that's a really good question, because most of what you see are...
I tried to bring it back to this,
Real.
Somebody did the hard work for me.
It is real. Okay, so, and you're not talking about inflation really, you're talking about a real return. And so what we don't do is we don't invest in ideas and hypothetical track records and all that sort of stuff, right? It has to be a real track record. It has to be somebody who's managed money. And so when I went around the world and asking, can smaller teams do the work of the large teams, right? The answer was unanimously yes, one. And two, you couldn't have done this 3 years ago. It's like Uber. Uber could not have existed 6 years ago. And what is Uber? Is it GPS? Is it a rating system? It is a payment system? Is it a bunch of unemployed people driving cars around? What is it? It's the mashing together of all those things. And so that's what I'm talking about here, is that we're at this inflection point in the history of asset management where you have the mashing together of all of these things, right? And so we only invest with people with real returns. And then I'll just do a comparison. In hedge fund land, is hedge funds, as I said, long, short equity hedge funds over the last 5 years got about 5% rate of return. Quantitative ones like the medallions of the world, if you can put your money into them, right? And that's a high,
yeah, right.
Good luck with that.
Medallions, sort of the holy grail of...
No, I was in the medallion fund since the beginning, right? And then
Until...
the fee started out at 5 and 20, and then a little bit later they said, hey, we're doing really well. we're going to raise them to 5 and 36, and you'll leave. No, I'll stay. I stayed. Now we're going to raise them to 5 and 44, right? And so I was like, okay, I'll stay. And then all of a sudden, in 2005, they said, thank you. You're out of here. And we're going to keep the alpha to ourselves, right? And so they have this like alpha engine that's that big, right? This tall. And then they come out with a new product with the alpha engine this big, and they say, that's for you. So I'm feeling honored to go into that low alpha product. But what they don't talk about is that their mission is to now grow this business from not a $3 billion primary Renaissance medallion fund, or whatever it is, and I don't want to use their name, but this is the case with most of the all very good quant shops, is they're growing this to a $40 to $50 billion business. And then everything changes, right? It totally changes. So maybe they have 600 employees, or maybe they have 1,100 employees now. And so they're stuck in a quarter, right? They can't move. They're going to have to argue against me, and I'd love to have a debate someday. And they're going to say, you cannot do this. You need to have all these PhDs. And I'm sorry, you don't. Now, what does that say for the industry? It says there's going to be massive amounts of unemployment, right? And unfortunately, the unemployment is going to come from people that were the Harvard and Wharton MBAs, because let's get back to the process. And that's where I really want to spend time. And then tomorrow, Adil can get into the weeds more. But the process that was always told, it's your edge of your information, it's how you process that information, and it's your judgment on the information. It's 3 parts to that process of generating alpha. Mm-hmm. So we already talked about the edge. The edge is gone, right? Unless you want to go to jail. Right?
In the traditional sense.
Yeah. Right. You can't dig deep into management and have the wink, wink, nod, nod. It's game over, right? And I encourage you guys to read The Black Edge. It's a great book, okay? So that's over. So you're in data land. Now, who's going to process that data? Well, most hedge funds historically had Harvard, Wharton, MBAs, business-type people applying Michael Porter, 5 forces analysis, all sort of stuff. And, like, if you're in data land, do you want Harvard guys doing this? I went to Harvard. Harvard's not very quantitative, right? As a matter of fact, I remember I had a course, the most quantitative course, and the professor cold called a student sitting down a few chairs away, and it was clear he had not prepared for this case, and it was the most quantitative sort of question. He said, so what would you do? And his answer was, well, I would walk across Weeks Bridge over to MIT. I would get 2 propeller heads, have them run the numbers, and I'd come back and I'd give you the answer. And I'd make the decision, right? But, if you think about that, it's a really weird dynamic, right? And it's kind of like, I'm here, I'm the captain of the industry, I'm the decision maker, I'm the Harvard MBA, and these guys do the stuff for me, right? And that's not how the world works today, right? And as a matter of fact, go out to the West Coast and tell everyone you're a Harvard MBA. It's like this. It's like, you need to work for me because we won the game in the last 10 years. The process-driven guys.
On that note, someone must have a question. I'm going to turn to you. We have a handheld mic, which we would like you to speak into. Here's one. No, there's a little switch.
Testing.
There you go.
All right. Could you give an example of kind of an equivalent of a 37th move that you've seen in the finance world with your models, like some kind of unusual analysis that a human would not necessarily have spotted?
Yeah. I mean, more recently, there are things like data sources that are coming out, like credit card data, and how you can anticipate certain companies and how they're doing based upon the credit card data. And it's actually interesting for me to see that, because in the old days, retail apparel and footwear sort of hedge fund manager would say, what we do, we hire these kids to go sit in a shopping mall and count the number of bags that walk out of whatever, Victoria's Secrets or whatever, and then we get an idea of what their sales are. And that's how they did it in the old days, right?
And we got satellites.
Then they went to satellites, and the satellites said, how many cars are in the parking lot at the shopping mall? Well, how many are going in? Okay, got it. And then you have some of the cell phone companies who say, inside, these people are doing this at this firm, they're inside actually buying some things. And then now you have the credit card companies saying, here's some interesting ideas. And so there have been some companies out there where you can get this information, and it's helped make some decisions, right? Yeah, that's one example.
Yeah. we're gonna have to. You want to just throw it up to me?
Yeah.
How about you say it and I'll ask it so it's through the mic.
Yes, I always struggle with the terminology itself of artificial intelligence. It sounds like everything you described today and what I've seen elsewhere is it's really just faster, better predictive analytics combined with data aggregation and more automation. So where do you actually cross the line between this is just better, faster predictive analytics with more data to actually artificial intelligence?
So, or a version of what you just said is like, where does it cross the line from being faster, better, cheaper into something that's actual AI, right?
Well, no, I'm not saying that artificial intelligence is at the level where you can trust it to run your money completely. I'm saying it's man plus machine. So the way I see it is augmented intelligence. That's the AI, right? Not artificial. And so here's the way I look at it: is that if you're kind of smart as a portfolio manager, how are you going to improve your intelligence, right? And I've realized, especially after I had this health issue this year, I was kind of reflecting back on my career and like, so where was my edge? What was I doing? And I realized I was searching for the brains, right? And really smart people. But smart people without the data and the information, and I see it kind of as an exoskeleton of the empowering to make better decisions. That's the way I look at it. And I don't think artificial intelligence yet is good enough to make judgments about things, but I think the combination of the two together. And I'll be brutally frank about this. I meet money managers all the time, and then I meet these young, and here's what you should do. Hang out with these 25 to 35-year-olds that are out there, and they're discovering all these ideas right now. And I'm only going to tell you is that that's how I started my business. I hung out with all these guys who are between 25 and 35. They reinvented the business, and it's about to happen again, right? Jim Simons reinvented the business. So I don't know if that's a good enough answer to your question, but I look at it as augmented intelligence.
Yeah, so I think what I'm suggesting is I don't actually believe artificial intelligence exists. Like, I think it's just a term that's been adopted because it's better, it's more advanced analytics with a lot more data using the computational power of machines to automate a lot more of that. And that isn't artificial, it's just bigger and faster.
I disagree. I think I'm living proof that artificial intelligence does exist because my intelligence is artificial. I'm joking. So
That got really quiet there for a beat.
So I don't think we disagree. I mean, what is artificial intelligence? All I'm saying is it's augmented intelligence for the money manager. And the money managers that are active managers are coming under constant pressure, right? And so are the indices the better way to invest your money? And you don't want to get me started on that because, I have whole philosophies about where we are and the whole cycle and everything about that. But this is the future. This is the future, is integrating in together data science, data scientists, machine learning, augmented intelligence. That's the way to go.
If I may, part of where this hockey puck is going, though, is that there are new ideas locked up in here that have never been explored before, right? Yeah. So maybe that's not an artificial idea, but you're potentially getting to things that you've never seen before, which might look like some of these themes that you're investing in.
Just simply saying every industry has been upended, except for the asset management business, by the discussion we just had. And who are we to be arrogant to think it's not going to affect us, right? And so how are we going to play that? How are you going to play that is you've got to hang out with 25 to 35-year-olds and to see what they're working on today. And I'm not saying that all of them are going to be good. I just gave you 200 that claim that they're doing something, but there's only like 35 of them that are actually really doing something. Yeah.
Mic check. Where are we at? Who's got a hand up for me? Back of the room to make it easy on us. No pressure. There we go.
What's your opinion of the crowdsource model of AI?
Yeah, well, a lot of press is out there about Numerai, and but actually, if you look at Quantopia, most of them had some sort of crowdsourced sort of model, and I think it works if you have the right structure. The reason why Numerai kind of changed the game is they issued their own cryptocurrency, and I know that's a controversial word today, but they're paying their people in a separate type of currency, and they're claiming, oh, that's interesting because you can either declare it or not. And look, I'm not from the IRS, so I have no comment on that. But then also, the more people that participate and use that currency, the more valuable it will become, right? And so I believe in the wisdom of the crowds. I believe that there are smart people out there that can contribute. There are scientists that might be someplace else. They don't want to leave their job. And they'll give a model to a Numerai or somebody else out there and help them get better rates of return. And they would be happy to get paid for that. So I believe that.
Speaking of, I think it's a good segue into fees in general, which you briefly touched on. But what incentive do you provide to the people that you're investing in?
We pay them a management fee. And then we
And that management fee is?
Instead of 2 and 20, there's a paper. You can read it out there. It's on P&I. We issued it in March. And here's what we think. We think the hedge fund industry needs to be restructured from a fee standpoint. And our suggestion is, first of all, let me give you the backdrop. I've been investing in hedge funds for a long time. And when David Swinson wrote his book in the year 2000, and by the way, I was on the board of the Investment Fund for a Foundation with him, and I was asked to come on the board to set up the first fund of funds for charitable foundations, and we did. But back in those days, we got low teens rates of return by being with 20 different hedge fund managers. And it kind of worked out, right? And I've just told you what the numbers are over the last 5 years or the last 6 years or 7 years. The world has changed, right? And so what we're saying is that, hey, do what you're supposed to do. Give me a 10% rate of return, and then I'll pay you a 20% incentive fee. So our structure is we'll pay you 1% management fee. We'll pay you a 10% incentive fee until you get a 10% return. And then once you're above that, we'll let you catch up your 20%. And then at about 12% return, then you get a 20% return. So 20% fee, right? So you can get your 1 in 20, but perform for us. This is your hurdle, right?
Is it to be done on a calendar basis, or should it be done, that should be calculated on a rolling?
I'm fine if it's a calendar basis. You know, the rolling thing, then you know what they're going to ask you to do? If you say, I want your fee paid in 3 years, what are they going to ask you to do? No, they're going to ask you to lock up your money for 3 years. I have no interest in that whatsoever. You know, the stuff that we're doing right now has monthly liquidity. And the whole industry changed, right? And it's just, you know, I think we're at a point right now where we say, come on, no more. Deliver what you're supposed to deliver. No more games. I mean, I'll tell you a game that we also wrote in P&I magazine that the hedge funds are doing, is that in the crisis, you know, everyone was pulling out their money, so the hedge funds say, well, we're going to put up a fund-level gate just to keep everyone in. And then the next thing they did is they created what's called an investor-level gate. So if you're an investor and you put your money in and you want it out, you can't get it out for 1 or 2 years, right? Every quarter they give you some. Why should an investor be penalized if they want to take their money out and the underlying portfolio is liquid, right? And so these things are happening in the industry, but it's all going to be restruck right now. And that's the good thing about, you know, how the world kind of moves. It moves in waves, and the power is going to come back to the investors.
I think we have time for maybe one more question. Got a hot mic. Who wants it? Okay, maybe in the back there.
How much is AI affecting like credit investing in some of the more difficult illiquid products?
That's a good question. I think it hasn't, except for the fact that look at credit scoring and the documentation, that's changing right now. There's a lot of kind of like firms that are out there trying to improve the process of like mortgage applications and all that sort of stuff. And then the other thing, on the flip side, the credit derivatives market, you know, one of the things that I'm pretty well known for is, you know, I backed John Paulson to do the short subprime thing. And back then, you know, credit derivatives were like trading at a private club, right? You know, you could get in, but you couldn't get out. These things are like really illiquid. And now they're exchanges. A lot of the credit default swaps are traded on an exchange. And so on the one side, the more that they're traded on exchange, there's more transparency and discovery. That's going to help artificial intelligence. On the other side, the underlying credits and the applications are being processed, and that's going to help. I don't think we're quite there yet, but I think we're going to get there. Does that help? Right? Good.
I'll wrap it up by saying thank you to Jeffrey Tarrant, thanks to PowerShares, and thanks to all of you for coming.